Leverage ratios are often considered when analyzing fundamental data for a company. They usually consider the liquidity or bill-paying ability of the company. Low liquidity can be a signal of bankruptcy. Leverage ratios vary immensely across industries, so comparisons should be done to peers within the industry. The use of debt and equity are financing decisions that every company must make. Market and economic conditions affect the decisions as each funding source is associated with risks and costs. Total debt to total capital ratio compares total debt to total capital from the latest balance sheet. Total debt includes both long-term and short-term obligations. Total capital includes total debt, total equity, and minority interest. Lower is typically better as it implies that the company has less of a debt burden. For example, a company with $10 million in total debt and $50 million in total capital would have a total debt to total capital ratio of 20%. A company with the same level of debt but only $25 million in total capital would have a higher ratio of 40%. The first company has less debt in their capital structure and more flexibility in financing decisions. Advantages of leverage ratios are that they are easy to compute and to understand. The ratios give valuable information about a company's operations. Disadvantages include that ratios are not comparable across industries, which can make evaluating the companies very difficult. The general trend in a ratio over time is informative. Falling leverage ratios may imply that a company's liquidity is declining or may hold other information about a company's cash management and debt levels. Viewing the components of each ratio separately can be helpful as well. If the total debt to total capital ratio is falling, is this because total debt levels are decreasing, or is total capital increasing? Or could it be a combination of both? In this example, Danaher's total debt to total capital ratio is near the 10-year low of 11%. The steep increases make it appear to shoot very high, but at its highest point it is only 32%. A lower leverage ratio is preferred often, though many industries use debt heavily and use of debt is often wise. Less debt might mean a stronger balance sheet, less risk to equity investors, less leverage, and more liquidity. More debt might mean more profitability. It would be wise to view the financial statements and filings to understand why debt has decreased or has equity increased relative in recent years.